A very good evening to all of you students. And first of all, I apologize because of some issues at my end. I couldn't join on time. There were some issues related to the connections. So, but I would surely make it up, during the session. So let us start with the today's topic on risk analysis and capital budgeting. So students, on capital budgeting, you would have already studied the very basics in capital budgeting. And till now, your knowledge, you would be aware of that capital budgeting involves study of cash inflows and cash outflows. Correct? So, you have already studied how to analyze a capital budgeting decision vis-a-vis their cash inflows and cash outflows. But in this particular topic of today, we are going to study how to take into account the risk part in the capital budgeting. How to take into account the risk and analyze that and to take into the capital budgeting decisions. So before we actually get into the exact requirement, let us first try to understand these three things. So I've put three things on board. Yeah, good evening, everyone. Good evening. I'm just seeing the responses on the query handle. So first of all, what is certainty? I think if we go with a literal meaning, certainty is something that we know is definitely going to happen. So there is no if, there is no but, something that is bound by an agreement and which is non-revocable. Correct? That is where certainty is. So can I say that this is something which is 100% bound to happen? Correct? For example, I definitely know that I'm going to pay rent because it is part of my agreement. And let's say that rent amount is 10,000 per month. Correct? So that is very much certain. So if anything is covered by an agreement which is non-revocable, that I would say is a certain thing. Now, what is risk? What is a situation which is called as risk? So the risk situation, I would say something where there is something that is going to happen in future, which I am not sure of that what is the exact outcome would be. In that case, if still I want to project something, what I will do, I will make different scenarios. So let's say scenarios, if I put, let's say, in scenario 1, the cash flow will be what? Let's say this is scenario 1, 2, 3, 4. Let's say there are 4 scenarios. The cash flow in the first scenario is likely to be 2000. This I'm just projecting because I know that, okay, there are 5 possible outcomes. Because it is a risky situation, hence I cannot say that this is going to be happen or this is bound to happen, right? So first scenario, 2000 rupees, let's say cash flow will happen. Second scenario, 3000 rupees. Third scenario, 5000 rupees. And the last scenario, I would say, okay, 1000 rupees. Okay, students. But with this piece of information, I might not be able to do anything else because this is just, I mean, there are 4 different scenarios with 4 different cash flows. I might not be able to incorporate it into my capital budgeting decision. So what I would also want to project is that what are the different probabilities of these 4 events to happen, of these 4 scenarios to happen, correct? I would say that, okay, again, I would say that, okay, for the first scenario to happen, according to me, there is a 20% probability. For the second scenario to happen, there is a 30% probability. For the third scenario, let's say there is a 40% probability. And for 1000 rupees cash flow, which is a fourth scenario, there is only 10% probability. So don't you think that this entire table defines a risky situation? A risk. Risk of what? Risk of different outcomes. Risk in which probability is being incorporated. And risk of different scenarios. Because I am not sure that what is certainty going to happen. Okay. Then let's come to uncertainty. Uncertainty is something which is a new situation, correct? Something called as a new, let's say a new business situation for which there is no established precedent, for which there are no bases, and anything can happen. Even I cannot predict these different scenarios 1, 2, 3, 4 with the cash flows and the probability. Even that also I cannot predict. That is total uncertainty. So this is one extreme. This is another extreme, right? But somewhere in between lies risk. Okay, I hope this terminology of risk, the context in which, because if you see risk is definitely a literal term also and a statistical term also that we're going to study. So I'm just trying to bring the context here. The context is practically you don't know that the cash inflows or cash outflows for future are going to happen on a certainty basis. Correct. Practically, the risk element is always there in your projections. That is where the need of this topic is. Okay. Now let's take this further because we are studying about risk. Hence, let's take this further. So we know that if we are, let's say, asked to calculate two things here. One is, let's say, if I am supposed to calculate an average cash flows. Can I calculate average cash flows? The average cash flows will be if I just simply divide the respective cash flows with their probabilities and arrive at a total. Correct? So 2000 to 20% is, let's say, 400. 3000 to 30% is, let's say, 900. 5, 4, 2000. 110% is 100. Correct? Yeah. So this comes as 3400. Correct? So I'm saying we can easily calculate what is the average cash flows by multiplying simply with their probabilities. Now, along with this average cash flows, if I give you this range, so the best possible outcome is this average cash flow, right? Which is 3400. But since there is a risk element, so there are chances that actually it might be higher or lower. Correct? Now, that higher or lower is the risk of cash flows. Let's say we denote it in the form of plus minus 500. Okay. That means you will end up having a lower amount of 2900. On an average, you can expect 3400. And at the max, you can expect 3900 of cash flows. That is what it is. Plus minus 500 is I will reduce 500 from 3400 to arrive at the lower range and the upper range. So don't you think this information is better to analyze any capital budgeting decision? Right? So instead of only putting, let's say that 3400 is going to be average cash flow, instead of that, if I say that, okay, 3400 is going to be average, but listen, there is an upper range and lower range attached to it on account of risk. So that is a better way to analyze a practical situation. So students, till now, any doubt, please do keep on posting the queries or your responses, whichever way, so that at least I know that we are heading in a right direction. So I'm saying that since risk is part and parcel of any decision making, whichever decision you take is going to be inherited in those cash flows. Thank you, Shubham. And hence, now let us connect back it to our capital budgeting. Okay, perfect. Now, in statistical terms, now let us try to see first of all what statistical term says. Okay, statistical terms, average, we call it as what? And risk, we call it as what? Can anybody tell me? I'm giving you an options here. Let's say mean, median, mode, standard deviation, variance. I've told you these many options. Tell me what fits into average and what fits into risk just by your preliminary thoughts. Okay, Kiran is saying all good. Darshan is saying clear. Sudhanshu is saying why take probability in calculating risk. Yes, Sudhanshu, we will cover your question in this statistical part. Okay. Aisha is saying how do we get the amount of plus minus 500? Very good, Aisha. So we will actually see now we are on that part only, that how we have arrived this, correct? Why are we multiplying probabilities? So we are answering all those questions, okay, through this. Bhumika is saying, sir, 3400 is the amount which is certain, but 2900 or 3900 are the uncertain amounts. Am I correct? So, Bhumika, again, I'm saying you are correct, but we should not link this uncertainty again to the extremity, right? As I said that 2900 and 3900 are again your best possible lower range and upper range, correct? And hence it is uncertain. So in a way, what you're saying is right. Darshan is saying average is mean. Perfect, Darshan. Sayyid is saying average mean, risk is variance. Very nice, Sayyid. Dikshita is saying average is mean. Perfect. Kiran is saying average is mean. Darshan is saying risk, standard deviation, variance. Very nice, Darshan. Komal, no query. Sudhanshu, SD is average, risk, variance. SD in average or risk variance. Okay. Varsha, average, median, risk is variance. Okay. Kiran, variance is risk. Perfect. Buduri saying average mean, risk, standard deviation. Perfect. Bhumika, average mean, risk, standard deviation. Shubham, they are for average. Okay, Shubham, I'll come to you. Bhumika, okay. Perfect. So hear me out, students. I think all of you have given wonderful attempts. I'm quite happy with the responses that we got. So average is actually mean and risk is actually standard deviation or variance, whichever way you want to see. I will actually come and explain why are we saying this. Okay. So first of all, coming to average is equal to mean. So while discussing this example, what I said that what is your best out of your different scenarios, scenario 1, scenario 2, 3, 4, what is your best possible outcome? So this is your best possible outcome, which is actually denoted by mean in statistical terms. Correct, because it will do all the averages. Now, in this case, since probability is involved, we will have to multiply probability in that respective cash flows. Because if I see that I have a 50% chance to get 1000 rupees and I have another 50% chance to get 500 rupees. So what is my best possible amount that I can get? Don't you think I will multiply 1000 by 50, which is 500, and multiply 500 by 50, which is 250, and hence 750 is my best possible amount that I can say to get. Still, this has a risk. Still, this has a risk because your actual will not be equal to 750, right? That is why we are saying this is a best possible outcome with a caveat of risk. Okay. I hope I am able to answer the first part. Why we multiply probability and why mean is used as average. Now for risk, let's first try to understand what is risk. Risk is basically deviation of possible outcomes from best possible outcome. So first of all, you leave behind what is standard deviation or variance. Let's first focus what is risk. See, risk is that I estimated 3,400 is going to be my cash flow. Just a second, students. Let me remove it from here. Yeah. So I ended up saying that 3,400 is my best possible outcome. But there is a risk. It might go up also. It might go down also. Now, if I have to analyze to what extent it will go up or to what extent it will go down, I will have to see that what are my different scenarios. My different scenario says that there is a 20% chance that it will be 2000, which is a deviation of what? 2000 minus 3,400. Correct? But that too at a 20% chance. Then in second scenario, the deviation is 3,000 minus 3,400. That too with 30% probability. The third scenario, there is a deviation of 5,000 with 3,400. That too at 40%. Similarly, like fourth scenario. So coming back here, the possible outcomes are what? 1, 2, 3, 4. These are the different possible outcomes. 1, 2, 3, 4. From best possible outcome, this is the mean or average. So if you see this, what we are doing here, we are trying to calculate the deviation of all the possible outcomes from the best possible outcome. And hence, this definition corresponds to standard deviation or variance from the statistical point of view. So Jay is saying, please explain the knee situation again. Okay. What I'm going to do is I'm going to take some more examples and I'm trying to explain you more on the risk. Okay. From there again, I will put up the complete explanation. But as of now, just register this small thing in your mind that we are trying in risk. What we are trying to say? We are trying to say that whatever average you have calculated, which is the best possible outcome, that there are chances that there will be deviations from that. Now, deviations can be higher also or lower also. For deviation also, we will again refer to this data set. So the deviation in first scenario will be 1400. In second scenario will be 400. Third scenario will be 1600. Last scenario will be 2400. Every possible outcome minus 3400. Okay. Now, let me go further because I will again actually explain the entire things and link it with the question. So at that point of time, it would be crystal clear to all of you. Okay. Now let's come to the techniques. The first part of technique is probability. It's not a technique, rather it's a concept. I think most of you would be aware what is probability. Probability is the chance of an event occurring. In very simple language, chance of an event occurring. It can be 0 to 1 or 0 to 100%, whichever way you want to see. In percentage terms, if you denote it, it will be 100%. In absolute or in, let's say, without a percentage, if you will denote it, it can be from 0 to 1. And it is always on a forward looking data. This is very, very important. Forward looking data needs to have probability with it, because history has already happened and those actual estimates are there with you. Since forward looking data is for future, you never know that what is the probability of that event happening. Okay. Now the formulas that are given. Now again, just note down these formulas. Don't get too with this formula. These are nothing if we just see the explanations. First one is expected net cash flows. What is the, and students, okay, one more thing. Wherever this term called expected, it is mean. Expected net cash flows, that is mean of cash flows, which is average of cash flows. How will you calculate it? By multiplying with the probability. So the summation of I is equal to 1 to n, which is the number of scenarios, net cash flow for ith term multiplied by probability for ith scenario. We will actually elaborate it through questions. So there you will be able to understand it better. Then expected net present value, which is also fairly very simple. I till n, which is in which you will have to take a summation. Expected net cash flow divided by 1 plus k raised to the power t. I will explain all these things. I will explain. So in this probability, we are actually studying two things. That first of all, for the cash flows, we will have to calculate the expected value. What is the best possible value that we need to calculate? Okay. Then basis the expected value that you have calculated, expected net cash flow, you will have to just take a present value of it and arrive at the expected net present value. So students, let's try to understand these formulas in a better manner through these numbers. Okay. So this is question number 1 from the assignment that has been uploaded. Please do refer it from there. So the probabilities for net cash flows for 3 years of a project are as follows. So they have given us what are the different probabilities. Okay, year 1, year 2, and year 3. Year 1, there are these 4 cash flows. I mean, there are these 4 scenarios again with different probabilities. Similarly, year 2 and year 3 that they have given. Calculate the expected net cash flows. First of all, they're asking us to calculate the expected net cash flow. Now, students, if you imagine, if I put it on a timeline, this is year 0, 1, 2, and 3. Correct? So, year 0, cash outflow has happened. Have they given us? Yes. Also, calculate the NPV of the project using 10% discount rate. Initial investment is 10,000. So, they have given us a cash flow of 10,000. This is fixed. This is certain. There is no element of uncertainty in this. Year 2, year 3, and year 1, we will have cash inflows. Okay. So this first part of calculating the expected net cash flow is fairly simple, right? Because what we will do, we will just simply multiply with the probability to arrive at mean. Calculation of expected net cash flows. So let's start with year 1, year 2, and lastly year 3. Year 1, what are the cash flows? Cash flow, probability, and expected cash flow. Again, for year 2, cash flow, probability, and expected cash flow. Year 3, cash flow, probability and expected cash flow. Okay, students. So Kiran is asking, is it T or F? Wait. So this T denotes time actually. It is T. T here is time. Okay. We will come to this formula through this question itself. So what are the cash flows given for year 1? Year 1 it is 2000 for first scenario with a probability of 10%. Year 2, sorry, year 1 second scenario is 4000 with a probability of 20%. Then 6000 with a probability of 30%. 8000 with a probability of 40%. So for calculating the expected cash flow, the best possible outcome, the mean, average, whichever name you want to call it will just be multiplied with the probability and the amount. Okay. So 10% probability I will get 2000. That means ultimately you will get 200 rupees. 20% probability you will get 4000. That means 800 rupees. Similarly, 6, 3, 18, 1800. 4, 8, 3200. And in totality, 5, 6000. So this is the summation here, correct? Then year 2, cash flows, you will get 2000. 4000, 6000. I'm just copying the data from question. 8000 along with the probability of 0 0.2, 0 0.3, 0 0.4 and 0 0.1. Expected cash flow will simply be 400, 1200, 2400 and then 800. In totality, it will be 4800. Year 3 again, 2000 with a probability of 30%. 4000 with a probability of 40%. 6000 with a probability of 20%. 8000 with a probability of 10%. Then it becomes 600, 1600, 1200, 800, and then finally the total of 4200. This is again summation. Yes, Jay, all of you please note it down, because in this, so basically what I'm trying to put here is the concepts as well as the questions, right? So while you will do the revision, you will need concepts as well as the questions both. So better to note it down. Okay. So you see, actually, this is what. Now let's tie back our formula that we have studied. I'm just putting down formula there. Summation of I is equal to 1 to n. Expected net, sorry, net cash flow, not expected. Net cash flow multiplied by probability of I. Okay. So here I is what? I is scenario 1, then scenario 2, then scenario 3, then scenario 4. So n is actually 4. I is equal to 1, 2, 3, 4. Net cash flows for different 1, 2, 3, 4 are also there, and probability for different 1, 2, 3, 4 are also there, which are multiplied and finally taken a summation. This summation of. Okay. I hope this formula is understood. Second year, I have written something wrong. 2468. 2468. 203041. 203041. 224 4312 6424 818 4 16 16 24 and 8. Just a second. I think here 2000 44 and 48. So this is okay. Year 2 is okay. Can you please check, Sudhanshu? Yeah. So second year, according to me, is okay. Maybe rest all can also vet it once. And Sudhanshu, maybe you can also check it again. 2341, yes. Okay. Then ultimately, what the question is asking? Question is also asking, also calculate the net present value. Correct? So we will have to write it here. Calculation of net present value. What are these? So 6000 is year 1, 4800 is year 2, and 4200 is year 3. Now I think all of you are champions to calculate the net present value, right? Because in entire capital budgeting, we have done that only. 1 plus 10% raised to the power 1, 1 plus 10% raised to the power 2, 1 plus 10% raised to the power 3, minus 10,000, which is the initial cash outflow. Correct? So if we solve this, then it becomes 12,573 minus 10,000. This is cash outflow, this is cash inflow. NPV will be 2573. And this actually ties back to the second part of the formula, which I've mentioned here, which is this one. Expected net cash flow divided by 1 plus k raised to the power t, which is the time for the different ones, and take a summation of. So this 12,573 is a summation of that formula. Okay, Sudhanshu, I hope that got corrected. Bhumika, perfect. Shubham, yes, correct. Thank you, Shubham. So I hope the formulas of the formulas that we have discussed in probability is clear, and the query that why we are multiplying probability to arrive at average is also clear, and the practical application of this formula is this only. Correct? It's very simple. We have to first calculate what is the expected best possible average mean, whatever you want to say, of the particular cash flows. Basis that we need to arrive at what is the present value, that is called as expected net present value. This is actually expected. Why we are putting expected? Because there is a use of probability and we have multiplied the same. Okay, students, now let's come to the standard deviation. Variance, standard deviation. Now let's do a proper discussion on this. So first of all, variance or standard deviation, we will come to what is the difference, but till now we have seen that under this is actually called as risk. Correct? Risk is the deviation of sorry students, just a second. Estimated values from expected value. So this expected value is mean. Estimated values are possible scenarios. Correct? The same language which I have written on top. Okay, Darshan is saying what we can interpret from this. So simply we can interpret that on a best likely outcome, you will get a positive NPV. Okay, basis whatever data set or fact pattern is given, basis that the best possible outcome is a positive NPV. Hence, you can take your decision accordingly. Okay. So coming back on variance standard deviation discussion, we discussed this is this. Then this is actually denoted by this sign. Standard deviation is actually denoted by this sign, but the square of this is actually variance. Okay. Variance is the square of standard deviation. Now for variance, we can actually write this net cash flows minus expected net cash flows raised to the power 2 multiplied by probability. I will explain this. This is the formula, okay? Now, what is this net cash flow? These are possible outcomes or different scenarios, correct? Or we have also seen estimated values, whichever way you want to understand. What are the different estimated values? Expected net cash flow is what? That we have just now seen, it is mean. Okay. So don't you think that if we are reducing both of them, this one and this one, we are arriving at something called as deviation between both of them. And why are we squaring them? Why are we putting raised to the power 2 here is because we want to calculate the deviation of negative and positive both in positive sense. See, if let's say in one case there is a negative deviation and you take that as negative amount, and in the second case there is a positive deviation and you take the positive amount, negative and positive will knock off and deviation will look smaller. However, there is a equal chance of that amount going down or up. So hence we will take a square of this so that the deviation amount comes in a proper manner. I will again try to explain it through example. Okay. But what I'm trying to register in all your minds is if we don't do a square, then raised to the power 2, sorry, if we don't do the raised to the power 2, then what will happen? The negative deviation will offset with the positive deviation because ultimately you're taking a summation, correct? And we don't want that. I hope I'm able to explain you the formula, and then ultimately we are multiplying with the probability. So this is what the formula of variance is. You have to arrive at standard deviation. So then you can take a square root of variance, correct? So this will give you the standard deviation. Now there are some thumb rules. Higher variance would mean higher risk. Lower variance would mean lower risk. I hope this is okay. So ultimately, if the what does it mean if there's a higher variance? Higher variance means higher deviation. Higher deviation means higher volatility. Higher volatility means higher risk. Lower variance means lower deviation and hence lower risk. We just now saw if we want to arrive at standard deviation, we have to take a square root of variance. And from your 12th knowledge, 11th and 12th, or let's say previous knowledge, we know that whenever we open a square root, we always do plus minus whatever that value comes, correct? That's what we do. And now you can relate it to what I told you in the beginning, plus minus 500, where mean was 3400, and I told you that risk is plus minus 500. Why I told plus minus? I'm proving you mathematically, because while you calculate the standard deviation, you take a square root. And while you open a square root, it's a plus and minus both. Shubham is asking some questions, sir, but why don't we just take modulus instead of squares? Because that will dramatically change the values. Okay, and taking the square, it will double it. Yes, I agree. It will not double it. It will multiply with the same number. Let's say 5 raised to the power 2 will be 25. It will not be 10. It will be 25. Your question is very valid. That's why in standard deviation, finally, we are taking a square root to eliminate that impact of double square. Okay. That's why standard deviation, we are taking a square root. I hope I am able to answer your question, Shubham. Okay, to eliminate the double exponential impact that is arriving on the risk. Okay. However, risk, if we talk about, practically both terms are used, variance and standard deviation also. Both terms are practically okay. The variance is also called as risk, standard deviation is also called as risk. But more so you will see in our curriculum, standard deviation is higher, has a higher weightage in terms of its usage in the questions and the study. Now let us go to a very, very interesting question. Now, students, hear me out. I'm just wrapping up the entire discussion on average and standard deviation, which is mean and standard deviation, okay, which is average and risk. There are two projects. Okay, there are two projects, project A and project B. If I say project A has a standard deviation, now for all my future discussion, I will restrict risk as standard deviation. Okay, I will say that risk is standard deviation. So standard deviation is given for project A as plus minus 100. Project B is given as plus minus 120. Can all of you tell me which project would you undertake? Basis this information, which project would you undertake? Project A or project B? Project B has a higher risk. Project A has a lower risk. Quickly, students. Waiting for a response. Okay, everyone is saying project A because it has lower risk. Okay, I got a. Okay, so Guduri is saying A, Kiran A, Varsha A, Shubham A. Lok Sundar is saying project A, Darshan project B because it leads to higher returns. Dikshita A, Sudhanshu. So only Darshan has a varying response because Darshan is saying that why can't you take project B? It has a higher risk and higher reward. Perfect. I'm getting some more responses. Okay, Shubham. Yes, Shubham is also raising a valid question, but we also have to consider the amount number because if we are expecting lower risk, that means outcome will also be low. Okay, Shubham, I'll come to your part. Budri is saying A, Komal A, Jaidas A, Aisha A, Varsha, more information. Very good, Varsha. I like that. But need more information. Risk factor can't make decision. Very nice. Sayed project B, Bhumika project B. Okay. So as I told, I mean, I agree with all your responses. So there is no one is right, no one is wrong. Because I only asked you that this is this limited information, which project you would go, A or B, and hence whatever came to your mind, basis that you have given the response. So here no one is right and no one is wrong. Okay. Because what I'm trying to throw now is mean of 500 and project B has a mean of 1200. I'm just trying to activate your cells. Okay. I'm just trying to activate your thinking here. Now with this information, do you think that project A, which had a lower mean, the best possible outcome, is having a lower risk? The higher risk is having 1200 of higher mean. So Kiran is saying yes, higher risk may not always be profitable. Yes, Kiran, because higher risk means that your probability of return going down is also very much high. So I agree with you, Kiran. So hence I'm saying I agree with all of you. There is no one is right, no one is wrong. These are all our judgments. But now what I'm trying to say, that makes sense. Why? Because I am linking it to mean. So don't you think that we need to compare in such a manner that what is the risk, unit of risk for 1 unit of mean? Correct? If we divide risk by mean, we will get that what is the unit of risk for 1 unit of mean. In this case, it will be 0.20. In this case, it will be 0.10. So I will end up for earning one mean, that is 1 rupee of cash flow. Here mean is cash flow. I will undertake a risk of 0.20. Here for one mean, I will undertake a risk of 0.10. Now you tell me, don't you think this is very practical and very logical that you will always choose this project? Because for the same level of return, that is 1, I have to undertake a lower risk of 0.10 compared to 0.20. Okay. The proportion of SD in project B is relatively lower. That's what Darshan is saying, and that's what I'm trying to compute here. Now, this is called as coefficient of variation. I hope your understanding is very clear. I'm not trying to explain you what is coefficient of variation. I'm trying to explain you the concept, and we are deriving then what is the meaning of coefficient of variation. Now, what does coefficient of variation does? Coefficient of variation helps us in comparing two different projects, or let's say two different data sets, if we have their respective mean and their respective standard deviations with us. Kiran? Yes. Okay. Perfect. I think now we are good to go to second question. Calculate coefficient of variation based on the following information. Project A and Project B, there are two projects that have been given. Possible events, they have given 5 possible events with the cash flows and respective probabilities both for Project A and Project B. Now, students, for calculating coefficient of variation, we need to know what is standard deviation divided by mean, correct? We need to calculate standard deviation and mean. For calculating standard deviation, any which ways we need mean, correct? This so we need only. So hence, let's first calculate the mean. Then let's calculate the standard deviation. Then let's calculate the coefficient of variation. Okay. So project A, project B, possible event, net cash flow, probability, expected value. Net cash flow, probability, and expected value. Okay, these are the three things. So possible event A, B, C, D, and lastly E. We have 5 possible events. Net cash flow, again copying from the question itself, 10,000, 12,000, 14,000, 16,000, and 18,000. Probability 10, 20, 40, 20, and then again 10. Expected value will be again just simply multiplication, right? 1,000, 2,400, 5,600, 3,200, and lastly 1,800. Total comes as 14,000. Net is 26,000, 22,000. This is for project B. 18,000, then 14,000 is also given in the question, 10,000 is also given in the question. The respective probabilities are 10%, 15%, 50%, again 15%, and 10%. So the expected value here will be 2,600, 3,300, 9,000, 2,100, and lastly 1,000. The total here comes out as 18,000. So this is mean, correct? Then similarly, calculation of variance. And standard deviation both, correct? Because first for calculating standard deviation, we have to calculate variance. Here we have event for project A and project B. So event is A. Okay, event in A event, we have 10,000 minus 14,000 is the mean, right? Raised to the power 2 multiplied by 10%, which brings us as 16 lakh rupees. Similarly, for project B, 12,000 minus 14,000 raised to the power 2 multiplied by 0.20, which brings us to 8 lakh rupees. I hope this is clear. So we are trying to calculate the deviation of respective amounts from their mean. Okay. For C, similarly, we have 14,000 minus 14,000 raised to the power 2 multiplied by probability of 0.40. This is dash because it is 0. And E. So for D, similarly, it is 8 lakh rupees. I'm just writing it and 16 lakh rupees with the same logic. So project A, this is the amount. Then project B, similarly, the first item is 26,000 minus 18,000 raised to the power 2 multiplied by 10%. 18,000 is mean and 26,000 is the first possible event. This brings this to a 64 lakhs, then 24 lakhs, then dash, then in D, it will be 24 lakhs, then it will be 64 lakhs. If we take a total here, summation 48 lakhs, and here it will be 1 crore 76 lakhs. So the standard deviation here will be 48 lakhs, 1 crore 76 lakhs. 2190.89 plus minus 4195.23. Okay, students. And finally, the coefficient of variation comes as A and B. 2190.89 divided by 14,000, which is 0.1565. 4195.23 divided by 18,000 is equal to 0.2331. These are the coefficient of variation. Project A is having a lower coefficient of variation. That means project A is better because for 1 unit of mean, I am getting a lower risk in project A. I'm just displaying it for all your benefit to note it down, and then we will probably move to the next part. Okay, I hope this is clear. Maybe if it is clear, you guys can put it so that I get a validation that we are again heading in a right direction. Thank you, Darshan. Shubham, Lok Sundar, Bhumika, thank you. Perfect. So let's come to question number 3. Question number 3 has appeared in November 2020 examination, hence it is of much use. This is very simple, right? A Limited is considering two mutually exclusive projects, X and Y. You have given below net cash flow probability distribution of each project. X and Y, they have given us the net cash flows and probabilities. Compute the following expected net cash flow of the project. This is mean. Variance of each project. This is variance. Standard deviation underscore of variance that we have calculated, and last one is coefficient of variation. These 4 parts sequentially we have just solved in question number 2, and this question is very much similar to that. And lastly, it says that identify which project to recommend. In this, we have already concluded this project is better, right? Because it has a lower coefficient of variation. So on similar lines, can you please solve this in your homework and get it? So Varsha is saying, why are we reducing 10,000 minus 14,000? Okay, let me explain again, Varsha. See, this 10,000 minus 14,000 is what essentially? For possible event A, how will you calculate deviation? You will calculate deviation that mean is saying 14,000, but your actual outcome is going to be 10,000. So there is a deviation of 4,000, right? At least for possible event A. Similarly, for possible event B, 12,000 minus 14,000, which is a deviation of 2,000. That's why we are reducing for different possible events. The different values multiplied minus mean multiplied by probability. Okay, Varsha? Darshan, what can be done if the sum of probabilities under each scenario totals to 1 or 100%? So always, Darshan, it will total to 100. Darshan is saying does not total. So what I'm saying, Darshan, always it will total to 100. Otherwise, some part is missing in the question. Correct. So practically, it's not possible that you are estimating for 30%, 70%, 90%, not for 100%. That is not possible. Okay. So always it will be 100%. So question number 3, I am skipping this because it is very similar to what we have just now seen. Okay, students, let me come to risk adjusted discount rate. Now let's come to third part. First one was probability. Second one was standard deviation and variance. Third one is risk adjusted discount rate. Now focus everyone here. Varsha, clear? Perfect, Varsha. Thank you. Everyone, please focus here. Risk adjusted discount rate. Now in your capital budgeting calculations, you would have always used one discount rate, basis which you would have calculated the present values. Now, let me first try to ask you what is interest, or rather, why is interest paid? Can all of you please try to answer? What are the different reasons due to which interest is appearing in our world? I mean, in our economic or financial world, why does interest appears? What are the primary reasons for this? Maybe all of you can give it a try. Perfect. I'm getting some responses. Varsha is saying cost of finance. Aisha is saying time value of money. Okay. Budra is saying opportunity cost. Perfect. Darshan is saying due to inflation, a source of income, right? Loksundar is saying to gain. Okay. Let me try to put it. I think all of you are right. But I'm actually bucketing entire reasons into two parts: time value of money and risk. Yes, I'm getting more responses. Shubham, inflation and opportunity cost. Gudri, to enhance savings. Perfect. Rajiv Kumar, because of loan taken. Kiran, changes value of money. Yes. Jay is saying to gain profit. Perfect. So I'm actually putting all these things into two parts. Sayyid is saying inflation. Yes. Dikshita is saying inflation. Pritika, inflation, as there is increase in value of money. Bhumika, interest is extra amount as per the predetermined rate we have to pay to maintain the time value of money. Perfect. Kiran is also saying changing values of money. Perfect. All of you are right. So now I am fitting all your discussion into two buckets. One is time value of money and second is risk. Now what is time value of money? Time value of money is 100 rupees today is not 100 rupees 1 year from now. The value of money keeps on deteriorating, right? So this is actually denoted by inflation, which most of you have answered correctly. So the inflation will drive time value of money and it will bring it down. Similarly, risk of non-payment. So what happens? So Krishna is asking, okay, Krishna, I'll come to your query after this, okay? So risk of non-payment, ultimately what happens if you are lending money to someone who whom you know that the credit rating is not good, the credit worthiness is not good. It might be possible that the borrower would not be able to repay the loan along with the interest also. In that case, you will charge the higher interest. That is called as risk. Higher risk, higher rate of interest you will charge. Because time value of money is constant, right? It is given from the market perspective. That is not going to change. So the interest actually is your discount rate. Correct? I hope all of you have realized. Now, if I tell you that there is a higher risk, what are you going to do? For that, let's first understand this. So discount rate, which is interest rate, is comprising of two things, risk-free rate and risk premium. I hope all of you will agree to it. So the risk-free rate and risk premium in totality will constitute discount rate, which is called as interest rate. So I'm taking, let's say, scenario 1. Risk-free rate is 7%. Risk premium is, let's say, 8%. In totality, discount rate comes as 15%. Scenario 2, if I take risk-free rate is again same, which is 7%, but risk premium is only 4%. And hence the overall WAC or the discount rate or the interest rate comes as 11%. Do you think that the higher discount rate will lead to lower present value? Yes, because if the same project you analyze the basis the discount rate of 10 to 20, then the present value will go down because the higher discount rate, the future cash flows are going to get discounted at a higher rate. That means it will drive the present value at a lower amount. I hope this is clear. So 15% would give you lower net present value. So what is the concept of risk adjusted discount rate? So the risk adjusted discount rate says that whenever you encounter a project which is very risky, which is very high on risk, that means it has a higher standard deviation, it has a higher variance, you increase your discount rate also. That is called as risk adjusted discount rate. Now, how much to increase, how to increase, that will be given in question, because that is again basis some of the scientific. Okay, students. So this is called as RADR. Now, Krishna was asking square root of 48 lakhs. How have we calculated 2190.89? So on your simple calculator itself, there is a square root option. So you can press that and arrive at what is the value coming. Where is it? Yeah, this one. Yeah. Sorry. So this 48 lakh square root will give you, from the calculator itself, will give you the under root value. Okay. So Jay, I will come to examples. Let me first complete the discussion on RADR and certainty equivalent approach. I will give you a lot of examples. Okay. Darshan, risk premium is beta coefficient. Okay. Darshan is trying to link it with the capital asset pricing model, CAPM theory. I would not say it is beta. It is already adjusted for beta. Risk premium is already adjusted for beta. Okay. Because it is specific to that project. Okay, it's not beta coefficient. It is beta multiplied with the market risk. Hence, it is a risk premium for this specific project. Okay. Okay, Darshan. I hope this is clear. So what we are trying to draw a correlation here is that if 15% you take a discount rate, that will drive your NPV down. If discount rate you take as 11%, that will drive your NPV higher. Then there is a fourth approach. I have to explain this also, then only I can draw some comparison between the two methods, and hence your understanding will become further stronger. But please hold on with me on this. Okay. Now understand here. I am taking two situations. Situation one, situation two. What are we saying in situation one? The risky amount is, let's say, 2 lakh rupees. So situation one, we have estimated that the risky cash flows will be 2 lakh rupees. That's all. That you can assume it's a best possible outcome or an average or mean, whatever you want to assume. But I'm just, for the sake of not adding complexity here, I'm just assuming that 2 lakh rupees is the risky estimate of the cash flow that is going to happen under situation one. For the same project, I'm taking a situation two where the information given to you is that guaranteed cash flow will be 1,50,000. So the guaranteed cash flow for this project, sorry, this is the certain cash flow. Again, let's link it back to the first part of my discussion. Certainty, risk, uncertainty. Certain. This is bound to happen. This is guaranteed amount. So guaranteed amount is 1,50,000. So the coefficient of certainty equivalent would be 1,50,000, which is the guaranteed cash flow divided by risky cash flow of 2 lakhs into 100, which is 0.75. So I am simply saying 0.75 times of risky cash flow is a guaranteed cash flow. This is called as certainty equivalent coefficient, and this entire approach, we will see how to apply it in the question, okay? And this entire approach is called as certainty equivalent approach. So in a way, what I'm trying to say is that 2 lakh rupees of risky cash flow is broken into two parts. One is 1,50,000 and second is 50,000. 1,50,000 is guaranteed. And this 50,000 is on account of risk premium. Correct? This extra 50,000 is because I am undertaking a higher risk. To compensate that, this additional 50,000 is making my 150 as riskier amount. So certainty equivalent coefficient will be guaranteed divided by risky amount multiplied by 100. If we have to calculate the guaranteed amount, I'm just removing 100 from here because that is just a percentage or decimal, whichever way you can decide. So guarantee is equal to certainty equivalent multiplied by this. If you have to arrive at the guaranteed amount, you can multiply certainty equivalent coefficient into the risky cash flows to arrive at the guaranteed amount. Yes, Darshan. Darshan is saying risky cash flows would always be greater than certain. Yes. Ultimately, higher risk would mean something higher than the guaranteed amount. Correct? That is why. Now let's come to the difference. I am now trying to draw some difference on RADR, which is risk adjusted discount rate, and certainty equivalent approach. Now this will make everything crystal clear in your mind. Hear me out for more 5 minutes, then we are done on these two topics. Then the solving of questions will become cakewalk for all of you. It would be very easy. So RADR, what we are saying, increase the discount rate. For risky projects, you increase the discount rate by adding higher risk premium for the percentage. What will happen in case of certainty equivalent approach? We are reducing the cash flows, correct? So what we are doing, we are multiplying certainty equivalent into the risky cash flows so that we are reducing the cash flows. Both of them have an impact on reduce NPV. This also will reduce NPV. Net present value will get reduced in both the cases, right? But RADR has a limitation. Same risk premium for all the years. Because your WAC, or let's say the discounting rate, is same for all the years, and hence you will end up assuming the same risk premium for all the years. However, in this case, you can have different certainty equivalent coefficients for different years. And hence this is somewhat better approach than the RADR. Okay. So if let's say we talk about some risky project, how would you account for a risky project? Risky project, in case of RADR, we will increase the discount rate, which will have a reduction on NPV. In case of certainty equivalent method, we will reduce the cash flows by multiplying the CE coefficient, which will reduce the NPV. Correct. Now, last thing in this will be cash flows and discount rate. For RADR method, you will take the risky cash flows and risky discount rate, correct? Which includes risk premium. I'm saying plus risk premium, correct? That's how you will do for RADR. Or you will use certainty equivalent approach, correct? Because you won't apply both. So either you will analyze the project from RADR perspective, and in the second case, you will analyze the project from certainty equivalent approach. The moment you apply certainty equivalent approach, your cash flows becomes non-risky, which is the guaranteed cash flows, right? And the discount rate also, you will have to use the risk-free discount rate. Then only it will make sense, right? If you use the risky discount rate, which includes the risk premium, as we are using in this case, then the answer will not come correct, because your numerator, which is the cash flow, is non-risky. That you are taking a present value with some discount rate, which is a risky one. Hence, it is wrong. So what I'm trying to draw here is that in CE, both cash flows and discount rates should exclude the risk premium. In RADR, both cash flows and discount rates should include the risk premium. Okay, students. So till now, we have covered probability, standard deviation, variance, whichever way you want to say. Then two more approaches, risk adjusted discount rate and certainty equivalent cash flows. So we will be solving questions related to the same. But before that, I would just want, or there is a request from my end that this session, instead of 9, the request is that we might have to stretch it, because we started also late because of some issues, as I said. So please expect that we will be around 9:30. That is one. And as of now, let's take a break of 10 minutes and again reconvene at 7:51. Okay. So students, welcome back after the break. Actually, I mistakenly told 9:30. The actual time of class was 8:30, so it will be extended by half an hour only. So which is 9 o'clock. Okay. Yeah. So there is one query from Varsha. Last point not cleared. Okay. And let me explain this point again. So what we are saying is, if we have to apply RADR or certainty equivalent method, you have to be consistent in what you are using in numerator as well as in denominator. Okay. You can't say that in numerator you take a risky cash flow, but in denominator you are taking a riskless, or let's say risk-free discount rate. That is not right. So these combinations are just given to clarify you, because the question will confuse you. The question will give you both risky rate and risk-free rate, and it will ask you to apply certainty equivalent. Then probably you will have to pick up only the risk-free discount rate. Okay. So that's why I thought I'll just put this point early, so that at least all of us are aware that what is the right thing to be done. Okay. Okay, Varsha. I hope this clears. Let's come to question number 4. Question number 4 says Gaurav Limited is using certainty equivalent approach in the evaluation of risky proposals. So they have mentioned that the approach is certainty equivalent approach. The following information regarding a new project is as follows. What are the following information? Year wise, they have given the cash flows. First is outflow and rest all is inflow. And the certainty equivalent quotient also they have given, which is the certainty equivalent coefficient, whichever way you can say. Now, since the question is asking us to apply the certainty equivalent method, the WAC, or let's say the discount rate, would be what? Riskless or risk including risk one? Darshan, thank you. Varsha, okay, perfect. So, what is actually the certainty equivalent quotient here? We will have to multiply in the expected cash flow, and the riskless rate of interest is already given, which we are going to use because we are using certainty equivalent approach. Our cash flows will already be certain, which is guaranteed, and hence we will use the risk-free rate of return. Okay. Determine whether the project should be accepted. It's simple. We have to calculate the NPV. If NPV is positive, we will go ahead with the project. If NPV is negative, we will drop the project. So solution. Let's come to year 0, 1, 2, 3, 4, and 5. Expected cash flow without any adjustment is what? Minus 4 lakh. 3,20,000 for first year. Second year it is 2,80,000. Then 2,60,000. 2,40,000 and 1,60,000. Certainty equivalent method will be 1, 0.80, 0.70, 0.60. These are the certainty equivalent coefficients that are given, while we can multiply them and calculate our risk less cash flows. Okay. So the riskless cash flows will be 4 lakh, simply 4 lakh multiplied by 1. Now 3,20,000 multiplied by 0.80 will give us the guaranteed amount or riskless cash flows, correct? As we have discussed above. 2,56,000. Then 2,80,000 multiplied by 0.70, which is 1,96,000. In the third year, the CE becomes 0.60 on 260, which is 1,56,000. Then 96,000 similarly, and lastly 48,000. then we can simply put present value factors at the rate of 6%, correct? Riskless 1, 0.943. These are the factors that I'm putting: 0.890, 0.840, 0.792, 0.747. Okay. This will give us the total present value as 4 lakh. Then 0.943 multiplied by 2,56,000. Correct? 241, 408. Then 0.890 multiplied by 1,96,000. 174, 440. 131,040. 76,032. And lastly 358.56. And hence the total amount will be 258,776. 258,776. So this is a positive NPV and hence the project should be accepted. Since NPV is positive under CE approach, the proposal should be accepted. Yes, Rajiv Kumar, it should be risk-free discount rate. Shubham also mentioned risk-free. Perfect. We should use risk-free discount rate under certainty equivalent approach. Clear? Very easy, very simple. No complexities. Just think from the pure logic building and then the things are really simple. Okay. Question number 5. A project requires an initial outlay of rupees 3 lakh. The company uses certainty equivalent method approach to evaluate the project. The risk-free rate is 7%. So first of all, company is using what? C method, and the risk-free rate of 7% is given, which is what we need. Correct? And initial outlay of 3 lakh. Following information they have given: cash inflows after tax and certainty equivalents also for the respective amounts. At 7%, they have also given us these factors, and this question has appeared in Jan 2021. This is very similar to the question number 4 that we have just now solved. Very similar, only the numbers are different, calculation, everything is same. So please do try this at home or in your practice questions. But I just wanted to show you that, just wanted to add the relevance from the examination standpoint. Okay. Let's come to question number 6. So this is some new question. Let's try to do this. Following information has been retrieved from the finance department of Corp Finance Limited relating to the projects X, Y, and Z. Okay. There are 3 projects X, Y, and Z. Net cash outlays, project life is also given, annual cash inflow, and coefficient of variation. What is coefficient of variation? Standard deviation divided by mean. You're required to determine the RADR, the risk adjusted net present value of the project, considering that the company selects the risk adjusted discount rate on the basis of coefficient of variation. Now, if coefficient of variation is 2, the RADR becomes 20% and the present value factor becomes 2.990. Very simple. I think the complexity is unnecessarily just to understand and link the entire part. So what we have to do here? Statement showing calculation of risk adjusted net present value. Okay. Projects X, Y, and Z. Cash outflow 42 lakhs, 24 lakhs for project Y, and project Z is 20 lakhs. Coefficient of variation is how much? 2, 0.80, and 1.60. RADR, risk adjusted discount rate, 20%, 12%, and 16%. Correct? Because at the rate of 2, the RADR is 20. At the rate of 0.8, RADR is 12. At the rate of 1.6, RADR is 16%. I hope this is clear. Okay, Krishna, I will try. I don't know whether this can be done or not, but I will try. I will check with the admin team and try to get it updated. Okay. But better if you are also noting it down and trying to solve it along with me, then it's better that you will all practice. All of you can, solve it and prompt the answers that you are getting, so that all of you are involved in what we are discussing. Then annual cash flows. So because I have done already the calculation in the interest of time, because we have limited 2.5 hours to cover the entire topic. Hence I've done already the calculations and kept it ready so that we don't waste time in doing the calculations. But if some of you are doing calculations and you are able to do before me, so please do prompt them, or please do send it, so that at least all of you are involved. So 42 lakhs, coefficient of variation is 2, RADR is 20%. So on 20%, sorry, first of all, we are writing what is the annual cash flow. Annual cash flows are given as this: 14 lakhs, 8,40,000, and then 6 lakhs. Present value factor will be what? Now, basis 20%, it becomes 2.990. Then basis 12%, it becomes 3.604. And basis 16%, it becomes 3.274. So the discounted cash flow will be 2.990 multiplied by 14 lakhs. Okay, which is 41,86,000. Then it is 30 lakhs, 27,360, 19 lakh, 64,400. In totality is not needed. There is no total needed because these are all different projects. And sorry. So these are the discounted cash flows. In the next sheet, we can probably calculate the respective NPVs. So the NPV X, Y, and Z will be 42 lakh rupees minus 4186, 24 lakh rupees minus 30 lakh 27,360, 20 lakh rupees minus 19,64,400. This is minus 14,000, right? This is 6 lakhs 27,360, and this is minus 35,600. So this project should be selected because it has a positive NPV. Correct? So project Y should be selected because this is having a positive NPV. That is why. I hope this is clear. It was very simple. The question has given us some data basis which we have arrived at RADR. Basis that RADR, we have arrived at the discount rate, multiplication factors, and basis that we have arrived at NPV. And we have compared all the projects XYZ. Wherever is the positive NPV, we have selected that. Z is positive. No, Z is not positive. See, okay, I have mentioned here like this. This is cash outflow. This is cash inflow. So NPV is cash inflow minus cash outflow, right? So you have to reverse the signs here. So 20 lakhs. So 19,640 is lesser than 20 lakhs and hence NPV is negative here. 35,600. Okay. Actually, don't go by sign. I have mistakenly written cash outflows first and then cash inflows. But here signs are perfect in this NPV column. Let's go to question number 7. Varsha is saying, okay, Darshan, what if PV factor isn't given in this, sir? Darshan, you are asking what if present value factor is not given? Then we can calculate, right? We can just simply do, see, for first year, what it will be. Let's say it's 20% is the discount rate. So first year it will be 1.12. Second year it will be 1.12 raised to the power 2. Correct? Then third year it will be 1.12 raised to the power 3. Then fourth year will be 1.12 raised to the power 4, and last it will be this raised to the power 5. And keep on adding everything. You will arrive at the value that is given in the question, which is present value annuity factor, basically the summation factor. Present value factor for year 1 to 5, you will arrive at like this. Okay, perfect. Let's come to question number 7. Question number 7 says the Textile Manufacturing Company Limited is considering one of two mutually exclusive proposals, Project M and Project N. There are two projects, Project M and Project N, which requires cash outlay of 850 and 825 respectively. Okay. The certainty equivalent approach is used in incorporating risk in capital budgeting decisions. The current yield on government bonds is 6%. And this is used as a risk-free rate. Perfect. The question is asking us to follow a certainty equivalent approach. And in that, since the cash flows are also riskless, the discount rate would also be risk-free, which is also given. The expected net cash flows and the certainty equivalents are as follows. Project M, Project N, along with the certainty equivalents they have given. Present value factor of ₹1 discounted at 6% they have given us the present value factors also at 6%. Analyze which project should be accepted. So very simple. Certainty equivalent method. Correct? What we are supposed to do here for project M, simply, what is the amount? 4,50,000 into certainty amount of 0.80 multiplied by present value factor of 943. Similarly, second is 5 lakh multiplied by certainty equivalent of 0.70 multiplied by 0.890. Then another one, 5 lakh multiplied by 0.50 multiplied by 0.840, which is the present value factor. This is the present value factor. This is certainty equivalent, and this is the cash flow. Simple. I'm just doing it on a rough basis because these type of questions we have already solved. 980, this is the summation less outflow. 850 is project M's outflow. So on net basis, NPV is 10,980. This is what NPV is. Similarly for project N, 4,50,000 multiplied by 0.90 multiplied by 0.943. Correct? Then again, year 2, 450 multiplied by 0.80, 0.890. Then again, 5 lakhs multiplied by 0.70 multiplied by 0.840. In totality is 996,315 less 8,25,000. NPV is 171,315. Okay, students. So project N has a NPV of 171,315. Project M has an NPV of 10,980. Now the second part of the question is very relevant. That is why, because I have used, if RADR method is used, they are saying if the risk adjusted discount rate method is used, identify which project would be appraised with a higher rate and why. So they're trying to ask that out of these two, what is the project which is higher in risk? How can we derive that? Ultimately, if the project is higher in risk, the certainty equivalent coefficient would be lesser. Correct? Because lower the certainty equivalent coefficient, higher the risk. Correct? Projects with lower certainty equivalent would be evaluated using higher discount rate as it implies higher risk. Perfect. So I think this is also we discussed. If CE is higher, certainty equivalent coefficient is higher, that means project is less risky. The risk of the project is less risky. Yeah? Now let's come to the last two techniques, which are also called as, which we have clubbed under other techniques. So A part is sensitivity analysis, very, very important and very relevant also, because practically lot of things we use sensitivity analysis in analyzing the changes of input to an output. So students, what is capital budgeting? I'm coming to a very basic question. This is capital budgeting. What is it? It is a model in which there are different inputs are required. Some of them are cash inflows, cash outflows, discount rate, time. So these are some of the inputs that are flown to this model. And once this model is there, it will throw something called as NPV as an output, correct? Okay. This is what capital budgeting is. It is a model in which some inflows goes and it helps in calculating the NPV as an output. Now, what is sensitivity? So sensitivity means the change in output in relation to change in input. What if I change these inputs, let's say by 10%, I increase the cash inflow by 10%, I increase the cash outflow by 10%, I increase the discount rate by, let's say, 1%, I increase the time of the project from 4 to 5 years. What impact it will have on the NPV? That is called as sensitivity. What magnitude it will change in the output is called as sensitivity. Okay. Darshan is asking, is it possible to determine the rate of risk premium when CE and risk-free rate is given? Darshan, I would say, see, if CE and risk-free rate is given, then you will end up calculating your NPV itself. Because CE also, the risk element is not there, and risk-free rate, the risk element is not there. So ultimately, you will not be able to calculate the risk premium in that. For that, at least you need to know what is your risk premium specific to that project. I mean, you would not be able to calculate from that. Okay, Darshan. The sensitivity, as I said, that it is a change in output with relation to change in input. That is called as sensitivity analysis. So we try to see that which input has a ability to drive a change in output. Okay. Let's come to question number 8. Question number 8 says that from the following details relating to a project, analyze the sensitivity of the project. Sensitivity of the project to changes in the initial project cost, annual cash inflow. These are all inputs, right? And cost of capital. These are all inputs to the capital budgeting. So the initial project cost is 120, annual cash, project, and cost of capital. Identify which of the three factors the project is most sensitive if the variable is adversely affected by 10%. So students, the question is asking us to calculate that where is it that the highest sensitivity lies. So first of all, we need to calculate what is the base case NPV, right? Without changing the variables, currently what is the NPV base? At the rate 10%. Project cost. Interest rate. So the present value of cash inflow in base case is how much? 45,000 is there, right? Multiplied by 10% is 3.169, right? The factor is 3.169. Project cost is how much? Minus 1,20,000. If you multiply this and reduce 120, the amount comes as 22,605. So this is the NPV at base case. No, Darshan. The definition of sensitivity and leverage is totally different. Okay, I will explain later why I'm saying this. But leverage is not sensitivity. Sensitivity, we will try to see from this question. What is sensitivity? Okay. So the base case is 45,000 multiplied by 3.169. If nothing changes, then what is going to be? In the second, so this is my first case. Second case, what I'm saying is if cash inflow gets adversely affected by 10%, how will cash inflow get adversely affected by 10%? If 45,000 brings down by, correct, gets down by 10%. So in this case, what we are going to do, 1 minus 10% multiplied by 3.169 minus 1,20,000. The net amount will be 8344.50. Now, what if project cost is adversely affected by 10%? In that case, project cost will increase. Correct. Then only it will be, we will say that it has an adverse effect. Now, in this case, 45,000 into 3.169 will remain same, and 1,20,000 will increase by 10%. So this brings 10,605 as the number here. Okay. Then the interest rate. Interest rate ultimately, how interest rate will be adversely affected? If 10% increases by 10%, that means it becomes 11%. Correct? And 11% we are given 3.103. Correct? 19,635. So what is the percentage change? 22,605 minus 8344.50 divided by 22,605. Correct? This is the change for this. Similarly, for this, the change will be 22,605 minus 10,605 divided by 22,605. Correct? And ultimately for this, it will be 22,605 minus 19,635 divided by 22,605. So if I just put the values, it becomes 63.08 percentage, 53.08 percentage, and 13.14 percentage. So 10 percentage change in inputs is driving these percentage change in NPV. This is NPV and this is input. Correct? So 10 percentage change in cash inflows is driving a NPV change of 63.08%. So don't you think the highest change is coming from cash flows? And hence the second part of the question which asks, sorry, the only part of the question which asks is the project which is the most sensitive. The most sensitive project is cash inflows. I hope you are able to understand, because only by changing 10%, this is actually driving 63.08 percentage lower NPV. That is why we are saying that this is a most sensitive input. I hope till now it is clear. Okay, students, shall we move on? Pritika is saying yes. Darshan, what is the benefit of analyzing the most sensitive variable? Okay. Now hear me out. So as a user or as a informed management, you need to know that whatever NPVs has been calculated are calculated basis some assumptions. Now, what are those assumptions? Those assumptions are all the inputs. For example, cash inflow, for example, cash outflow, for example, discount rate. Now, they also need to know that what will happen to NPV if one of the assumption goes for a toss. Let's say cash inflow, it is increased. Sorry, it is decreased, or it is increased both ways. It can increase also, it can decrease also. So they try to see that what is the stress level testing for NPV, at which value my NPV will become 0. You're getting my point? So they will try to answer these questions, and hence the benefit of analyzing sensitivity is far beyond than this calculation. Okay. Okay, Bhumika is saying, please can you explain this question in brief? Okay, I will explain it. So Bhumika, see, the question first of all said that there is one analysis on the base case. Base case means you assume nothing is going to change. Whatever is given in initial project cost, you assume that. Whatever is given in annual cash inflow, you assume that. And basis that, you arrive at some NPV. But question is saying that for all the three inputs, because see, it is saying they are trying to analyze the sensitivity of the project to initial project cost, annual cash inflow, and cost of capital. If they're trying to analyze this, then we have to take one factor at a time and change it and see what is the impact because of that factor. Correct? Then only you will be able to see that what is the impact of reducing the cash inflows by 10%. What is the impact of what is the impact of increasing project cost by 10%? See, the question is very smart, because question is saying that you have to assume that everything is adversely affected. Now you have to interpret it how adverse impact will come because of the cash flow. If you reduce it or if you increase it, if you reduce it, right? How adverse impact on NPV come because of project cost? If you increase it or if you reduce it, if you increase it, correct? Because project cost is your cost. How adverse impact on NPV would come because of the interest rate? If you increase it or if you decrease it? Definitely, if you increase it. The moment you increase it, your NPV will go down. That's why, Bhumika, that's why we have assumed one change in a factor at a time and tried to arrive at NPV change, and hence what is the sensitivity. Okay. Then let's come to the last topic. Scenario analysis. Now in sensitivity, what we did, sensitivity, we changed one factor at a time. Changed one factor at a time, correct? But scenario, what we did, I mean, what we are going to do, sorry. Sensitivity, we change one factor at a time. Scenario, we have different scenarios of different inputs. I hope you will be able to make a difference here. Scenarios, so let's say scenario 1 will have cash inflow, cash outflow, discount rate of 1 lakh, let's say 50,000, and discount rate of 10%. This is scenario 1. Scenario 2 will be changes in all the inputs. Let's say it is 120. This is 60. This is 9%. This is scenario 2. So you will have to find NPV basis scenario 2. Here you will have to find NPV basis scenario 1. So it is very easy. In this case, you will find NPV of the different scenarios that you have. Simple. No need to calculate one factor at a time. Take all the factors different at the same time and calculate the scenario numbers. Let's come to this, the very last question, which is again very, very important question. So we will spend some time here. Yes, Darshan, you're right. Bhumika is saying crystal clear. Thank you. Darshan, thank you. Rajiv Kumar, clear. Darshan is saying we have learned about scenario analysis and strategic management, in which we learned that it is used to reduce the uncertainty. It is, yes, in a way, it is helping you to reduce uncertainty, right? Because now you will be in a proper awareness stage that at max, what is going to happen in case, let's say tomorrow, if my input is changing by 10%, then what is the impact coming to my NPV? If it is helping me, if it is coming below my threshold limit, then that's a decision maker or decision breaker, right? But if my, let's say, threshold limit is very low, and even by reducing 10%, NPV is still coming higher than the threshold limit, then that means it is good to go. Okay. Now, if you want to actually further see in the financial statements, okay, let me deviate from the topic and tell you something interesting fact about sensitivity analysis. Today only, after this session, if someone of you is interested, please open any company's annual report and try to go to the disclosures of actual valuation. Okay, where you will find that there is a sensitivity analysis that the actual report on employee benefits, I'm saying, because in employee benefits, there are certain inputs that goes that what is the salary escalation rate, what is the discount rate, what is the death rate, right? All those input goes. So for all those inputs, the companies are required to disclose the sensitivity of the output. In case of actual valuation, the output is provision of gratuity, right? So it will show you that what is the impact happening on the provision of gratuity if we change by 1%, let's say the discount rate. If we change 1%, let's say the salary escalation rate. Okay, so sensitivity is actually used in practical life in lot of concepts. One of them being gratuity valuation from actuarial. Okay. If some of you are, exposed to this in your audits also, please do check this specific, or let's say, please do understand how the sensitivity comes in an actual report on employee benefits. Otherwise, just take any example, take any annual report download from the, Google, for any company, for any big company you take, they will disclose that what is the sensitivity on actual provision because of the changes in inputs. Okay. That will help the readers of the financial statements to understand the provisioning better. Okay. Let's come to question number 9. PNR Limited is considering a project with the following cash flows. Now, this is very good question, actually, very, very important and good to understand the overall concepts. They are saying that the cost of plant is this much, running cost they have given, and the savings also they have given. That is year on year. The cost of capital is 12%. Measure the sensitivity of the project to the changes in the levels of 1. Plant cost, 2. Running cost, 3. Savings. Consider each factor at a time. Please see, students, question is very clearly specifying you. This is not a scenario analysis question. This is a sensitivity analysis question, because they are asking us to consider one factor at a time and consider in such a way that the NPV becomes 0. In this case, they have categorically told you that you don't, they have not given you anything, any change on input. Rather, they are expecting you to drive the change on input from the change in output. That's making the NPV as 0. Okay, so in the equation, they have, till now they were giving you one part and asking you to calculate the other part. Now in that equation, they have given you the other part and asking you to calculate the first part. Okay, we will explain in the solution. 12% basis factors are given. Determine the factor which is most sensitive to the affect the acceptability of the project. And then they are asking us that what is the most sensitive project. I mean, what is the most sensitive input to the project? So we have three things here. We have three inputs: plant cost, running cost, and savings. This one, and this one. These are the three inputs. Change one at a time. So first of all, we need to calculate the base case NPV. Base case NPV year 0, 1, 2, 3, and then total cost of plant. How much it is? 12 crore. 1200 lakh. This is 12 crore. Cost of plant is actually this much. I'm removing this total column. This is not needed actually. Okay, then running cost. Running cost year 1 it is 0. Year 2 it is 4 crore. Negative. Correct, because running cost is an outflow. Savings is your inflow, right? 5 crore year 2. 6 crore year 3. 4, 5, 6. Perfect. Then savings. First year 12 crore. Then next year 14 crore. Then last year 11 crore. So can we say that year on year without present value, what are the totals? 12 crore in first case. Second case it is 8 lakh, 8 crore positive, which is 12 minus 4. Then 14 minus 5 is 9 crore. Then 11 minus 6 is 5 crore. This is for year 3, correct? And then we can just simply multiply the present value factors at the rate 12%, correct? Yes, 12%. That is also given in the question. 1 for year 0, 0.892 for first year, 0.797 for second year, 0.711 for third year. Now the NPV will be 12 crore plus 7 crore 13 lakh 60,000 plus multiply this with above 9 crore. Then we will get 7 crore 17 lakh 30,000 plus multiply this 7.11 with the 5 crore number. We will get 3 crore 55 lakh 50,000. And hence the total NPV here comes as 5 crore 86 lakh 40,000. I hope the base case NPV calculation is clear. So currently the NPV is positive by 5 crore 86 lakh 40,000. Okay, students, this is clear. This is simple calculation. We have just taken the cash inflows, cash outflows, multiplied with the present value factor and arrived at the NPV. Now the question says that you have to change your inputs in such a way that your NPV becomes 0 and take one factor at a time. So let's first of all take plant cost. Simply your plant cost needs to be increased by 5 crore 86 lakh 40,000 to make NPV as 0. correct? Because plant cost is in year zero. Year zero has one present value factor. So whatever you change in your plant cost, it will, thank you, Pritika. So it will change your NPV to zero, correct? So percentage change will be 5 crore 86 lakh 40,000 divided by 12 crore. This is 48.87%. So your plant cost needs to be increased by 48.87% to make your NPV zero. This is the sensitivity. Now let's take running cost. So ultimately running cost needs to be increased by 5 crore 86 lakh 40,000 across all the 3 years, correct? But we are not going to allocate this to the 3 years in this. What we will do is we will just take the present value of this running cost as the year zero cost, correct? Because if we arrive the present value, then that is the current running cost. That has to be increased by 5 crore 86 lakhs to make the NPV zero, correct? I will show you how. So the calculation will be 5 crore 86 lakh 40,000 divided by 4 crore multiplied by 0.892 plus 5 crore multiplied by 0.797 plus 6 crore multiplied by 0.711. So if you see in the denominator, this denominator is what? This denominator actually is the present value of the running cost. So whatever it comes out, that has to be increased by 5 crore 86 lakh 40,000 to make NPV as zero, correct? So this comes as 49.61%. And the similar logic will apply to the savings part. So to make NPV zero, savings should go down, correct? Savings will come down, then only NPV will become zero. But again, by what amount? 5 crore 86 lakh 40,000 as present value divided by 12 crore 0.892 plus 14 crore 0.797 plus 11 crore 0.711, which is 19.75%. It has to come down. Now let's try to put everything in this one table: plant cost, running cost, and then savings. Percentage change in input is how much? Here it is 48.87%. Running cost is 49.61%. This is 19.75%. Okay. And with all these changes, NPV will become 0, 0, 0. Now, students, comes the last question from mine to all of you. Can you tell me, using this table, which factor is most sensitive to NPV? Option A, plant cost. Option B, running cost. Option C, savings. This is the last question of this class today. If all of you are able to understand what is this question all about, this question is all about again on the sensitivity analysis in such a manner that the NPV should become zero. How NPV will become zero? First, we have to calculate what is the NPV. Whatever is the NPV, that straight away needs to increase the plant cost. At if we are only going to change plant cost, then plant cost needs to increase by 48.87%. If you are only going to increase the running cost, it needs to increase by 49.61%. For savings, if we are going to reduce our savings, it needs to be reduced by only 19.75% to make NPV zero in all the three cases. And this is where I land up. Very good. Hira Hussain is saying saving factor is more sensitive to NPV. Shubham is saying savings. Guduri is saying option B, okay, which is running cost. Rajiv Kumar is saying running cost is more sensitive. Bhumika is saying savings. I'm waiting for more answers to come. Then I will tell the correct answer here. Bhumika is saying savings. Varsha is saying savings. Pritika is saying C, which is savings. Perfect. So let me, break the suspense here. This is the most sensitive to NPV. And the reason is a very small change of 19.7% in input is making NPV zero. Here the running cost has to change by almost 50% to make NPV zero. But here a small change, I mean very less than compared to what it is in plant cost and running cost, savings has to only change by 20%, which is 19.75% to make NPV as zero. Hence it is most sensitive. So in the previous question, we were actually looking at the percentage change in NPV, which is output. That is where we have saw that where it is maximum. But here we are looking at the percentage change in input. So there we have to look what is the minimum. Chinmay Das C, Pritika C, Varsha since savings, Bhumika savings, perfect. I think all of you are correct. Only running cost, whosoever is answered, but please try to think it that running cost is not most sensitive. Rather, the running cost has to change by very high magnitude to change the NPV. I think not bad. The way we started very late, we have covered what we thought in the today's session. So I'll meet you in the next session. I hope you enjoyed today's session, and sorry again for being, initially we were not able to start on time. So yeah, I think till we meet in the next class, please do revise these entire concepts. In the next session, we would be covering dividend decisions. And if you have any queries, please do ask on this topic as well as the topics that we are going to cover. So until then, please do revise well. Okay. See you. Good night. Thank you, everyone.